Most backtests look profitable because they are testing the past too perfectly. The real question is not whether a strategy worked on old data, but whether it can survive on data it has never seen before. In this video, I'll show you how to backtest with Claude Code the right way by building a more realistic testing process, using walk-forward analysis, checking for curve fitting, adding trading costs, and avoiding fake results that look good on a chart but fail in real market conditions. This is not financial advice. This is a practical guide for testing trading ideas more honestly before trusting any strategy. Number 1. What proper backtesting means. Proper backtesting does not mean finding a strategy that looks amazing on an old chart. Proper backtesting means checking whether a trading idea still works when it is forced to deal with data it has never seen before. That is the whole point. A lot of people think a strong backtest is one that shows a high return, a smooth equity curve, and a low drawdown. But those numbers can be completely misleading if the strategy was optimized on the same data used to judge the result. This is why many traders feel confused. They build something that looks profitable in a normal backtest, then the moment they try to use it in a live market or even paper trade it forward, the performance gets much worse. The strategy did not fail because the market is unfair. It failed because the testing process was weak. The model was rewarded for memorizing the past instead of proving it had a real edge. That is where Claude Code becomes useful. Instead of relying on a simple platform backtest, you can use Claude Code to help build a custom testing workflow in Python. That gives you more control over the exact rules, the data windows, the costs, the metrics, and most importantly, the difference between training data and unseen test data. If you want to backtest the right way, your job is not to create the prettiest chart. Your job is to remove as much fake performance as possible. Number 2. Why normal backtests lie. The biggest reason normal backtests fail is curve fitting. Curve fitting happens when you keep adjusting parameters until the strategy perfectly matches the historical period you already know. It feels smart because the results improve every time you tweak the numbers. But what is really happening is simple. You are teaching the strategy to fit one specific slice of market history instead of teaching it to survive new conditions. A good way to think about it is this. Imagine a student who gets the answer sheet before the exam. That student might score perfectly, but that does not mean they understand the subject. A full history optimized backtest works the same way. If you test one strategy across years of data all at once, then keep changing the settings until the chart looks great, you are not discovering edge. You are discovering the best way to describe the past. This gets even worse when people use many filters, many indicators, and many thresholds. The more knobs you can turn, the easier it becomes to create a strategy that looks brilliant on old data. That does not mean those ideas are useless. It means the testing standard has to be higher. If your backtest uses the whole dataset to find the best settings, the result is not proof. It is an in-sample illusion. The solution is to separate learning from testing, and that leads directly into walk-forward analysis. Number 3. Build the right workspace. The practical setup is straightforward. Open Visual Studio Code, create a clean project folder, and use Claude Code inside that workspace. You do not need to write everything manually. The smart way is to make Claude Code build the first version of the app. Then you review, fix, and tighten the logic as you go. Claude Code is fast, but it still needs good instructions and careful checking. Your first prompt should be focused and specific. Tell Claude Code to build a Python backtesting app with a simple interface, historical price data, a walk-forward engine, realistic trading costs, and clear performance metrics. A practical stack for this is Streamlit for the app interface, Plotly for charts, and Yahoo Finance data for testing. That gives you a fast environment where you can choose a ticker, set the start date and end date, adjust the training window and blind test window, then run the analysis fold by fold. This matters because a proper backtesting engine is not just one script that prints profit. It should show what the model trained on, what it tested on, What parameters were chosen in each round, how many trades happened, what the costs were, and how performance changed from one fold to the next. If Claude Code creates something too simple, do not accept it. Ask it to expose more information, especially fold details, selected parameters, transaction costs, drawdown, and separate in-sample versus out-of-sample performance. The more transparent the engine is, the harder it becomes for fake results to hide. Number 4, use walk-forward testing. This is the core process. Instead of giving the strategy all historical data at once, you break the timeline into rolling windows. A practical example is a 12-month training window followed by a 3-month blind test window. During the training period, the strategy is allowed to search for the best parameters. Once those settings are selected, they are locked. Then the exact same settings are tested on the next 3 months of data that were not used during optimization. After that, the whole window moves forward and repeats. So if the first fold trains on 1 year and tests on the next 3 months, the second fold moves forward and does the same process again. This creates a chain of small real-world style evaluations. Each fold asks the same question. If I optimize only on the recent past, do those settings still help on the next unseen period? This is much more honest than a standard backtest. It does not guarantee profit, but it does force the strategy to prove itself in conditions that are closer to reality. The key rule here is that your final equity curve should be built from out-of-sample results only. Do not mix training returns into your final performance summary. That is one of the biggest mistakes beginners make. They optimize inside the training window, see good results there, and accidentally count those returns in the final performance. That defeats the whole purpose. The stitched results should come only from the blind test windows, because that is the part the strategy did not get to see in advance. Number 5, start simple and expose weakness. The right way to begin is with a very simple baseline strategy. For example, you can ask Claude Code to test a basic setup where the relative strength index crosses above an entry threshold and price is above a 20-period simple moving average. That kind of strategy is not special, and that is exactly why it is useful. It gives you a clean starting point and makes it easier to see whether your engine is honest. In a normal full history backtest, even a simple strategy like that can look much better than it really is. You might find parameter settings that seem to avoid bad periods and capture good ones, and suddenly the chart looks impressive. But once you force the strategy into walk-forward testing, the story often changes. The performance becomes smaller, less stable, and much more realistic. That is not bad news. That is the first truthful result. When you run your baseline, check more than just return. Look at Sharpe ratio, maximum drawdown, number of trades, win rate, average trade, and how stable the chosen parameters are from fold to fold. If the best settings swing wildly every time the window moves forward, that is a warning sign. It suggests the strategy is not finding a durable pattern. It is reacting to local noise. Also add trading friction from the beginning. Even a simple cost model like exchange fees and slippage at 0.1% can completely change the outcome of a high turnover system. If your strategy only works before costs, then in practice it does not work. Number 6, upgrade carefully without cheating. Once your simple strategy is tested honestly, then you can improve the logic. This is where many people go wrong. They assume that more advanced math automatically means a better edge. It does not. You can still overfit a sophisticated strategy just as easily as a basic one. Claude Code is useful here because it can quickly replace one signal engine with another, but you still need to understand what the model is doing. A stronger next step is to move from a lagging indicator setup to something like volatility-scaled momentum. In plain language, that means measuring directional strength while adjusting for how volatile the market is. You can also smooth noisy price data before calculating the signal. A common method is a low-pass filter, but this is where one of the most dangerous mistakes appears. Some smoothing methods use future data without making it obvious. If that happens, your indicator looks cleaner and your backtest looks smarter, but the result is fake. When Claude Code writes filtering logic, inspect it carefully. If it uses a method that relies on future bars to calculate the current value, that creates look-ahead bias. You never want future information leaking into today's signal. In practice, that means you should prefer forward-only logic. If you tell Claude Code to smooth the data, explicitly say the filter must be causal and must not use future prices. This one detail matters a lot because AI coding tools often generate code that looks mathematically elegant but is not valid for live trading. So the rule is simple. Better math is fine, but only if the data flow still matches the real world. Number 7, check the results like a researcher. After the engine runs, do not stop at the headline return. A proper review is where most of the value comes from. First, compare in-sample performance against out-of-sample performance. If the in-sample line looks incredible but the out-of-sample line is weak or flat, that means most of the original edge was probably optimization noise. Second, look at parameter stability. If one fold chooses extremely different settings from the next, you may not have a robust strategy. Third, check market regime behavior. Did the strategy only work in strong bull markets? Did it break during sideways periods? Did it collapse during volatility spikes? A strategy that only survives one environment is fragile. Fourth, check trade count. If the result comes from a tiny number of trades, you should not trust it yet. 1 or 2 lucky windows can distort the whole backtest. Fifth, test other assets and nearby settings. A real edge usually has some tolerance. If moving one parameter a little bit destroys the whole result, that is another warning sign. Also verify the data itself. Make sure the dates are correct, missing bars are handled cleanly, and the market you are testing actually matches the constraints you care about. If you plan to trade liquid large-cap equities, do not pretend a crypto-style execution model applies. If you plan to trade intraday, daily bar backtests are not enough. Before trusting any result, ask a boring but powerful question. If this strategy were live tomorrow, using only information available at that moment, with realistic costs and position sizing, would the same logic still exist? If the answer is not clearly yes, keep testing. Number 8, what to do next in real situations. If your walk-forward result is much worse than the standard backtest, that does not mean the project failed. It means the engine worked. You just avoided believing a false edge. In that situation, do not immediately start adding more indicators. First, identify what actually failed. Was the strategy too sensitive to one period? Did costs erase the edge? Did it trade too often? Did the parameter choices jump around too much? Solve the real weakness, not the emotional disappointment. If the strategy produces almost no trades, widen the logic carefully or test a longer history. If it has too many trades, tighten the rules or increase the cost assumptions. If it works on one asset but nowhere else, ask whether the idea is genuinely asset-specific or whether it is just overfit to that chart. If Claude Code keeps producing code that is too complex, tell it to simplify the implementation, explain every metric, and separate each step into clear functions for data loading, signal creation, optimization, walk-forward testing, and reporting. The most practical habit is to treat Claude Code like a fast research assistant, not an oracle. Let it generate the structure, the dashboard, the loops, and the reporting, but you decide the testing standard. Keep the workflow honest. Use rolling training windows. Lock parameters before the blind test. Stitch only out-of-sample returns. Include fees and slippage. Watch for look-ahead bias. Compare simple logic against more advanced logic. And if a strategy becomes less impressive after honest testing, trust the honest version, because that is the one that has at least a chance of surviving outside the chart.